On Wednesday, December 13, 2023, the Fed delivered the best Christmas gift ever. From the most recent thoughts of the week on December 15, 2023, we read,
"Over the last few months, we have highlighted that the Fed should be done with its tightening cycle based on real-time, high-frequency data that suggested that economic growth and inflation were cooling. And on cue, the Fed this week reinforced our views and signaled that rate cuts were on the horizon."
This pivot was better than the pause the markets had been expecting. As a result, capital markets have rallied nicely. The market thinks it can't lose with the Fed's policy pivot on interest rates. We should remember that the capital markets anticipate what's next. In this graph, we see how the Nasdaq fell off a cliff from November 30, 2021, when Jerome Powell ditches transitory tag, paves way for rate hike. The Nasdaq Composite Index is still down -9.4% from that time. The main idea is that the stock market began to decline 4 months prior to rate cuts, then fell in earnest in March 2021 with the first rate cut. 2 years on, Jerome Powell has heralded the imminent arrival of the long-sought pivot. We read from the weekly headings the following.
"It appears the Fed is satisfied that Fed hikes have contained inflation and now it will turn its attention to the economy. As a result, we expect the Fed to cut interest rates 3 to 4 times in 2024 beginning in July."
Let's look at how the Nasdaq and the S&P 500 have reacted since November 1, 2023. We see that the Nasdaq index in purple is up over 14%, and the S&P 500 in green is up over 12% through December 15, 2023. This may be in anticipation of the Fed pivoting. We can see from this graph that typically, the Fed waits to cut rates until there is a recession as demonstrated in pink. This time, the expectation is that the Fed will reduce interest rates as the economy slows down. If the Fed cuts prior to a recession, we may have the makings of a soft landing as depicted in this graph. In this scenario, inflation graphed in orange continues to decline without any meaningful increase in unemployment, as shown with the red line. This progress may prompt the Fed to decrease from the current 5.25% to 4.5% next year. This has caused analysts to posit that the Fed getting its desired soft landing, that is inflation falling without job destruction, may be likened to Goldilocks getting her porridge just right. The prospect of a Fed pivot is compelling. However, wait, there's more. We are about to get the lift of a lifetime in that the fiscal stimulus enacted by the following historic legislation has begun to kick in. The $1 trillion Bipartisan Infrastructure Investment and Jobs Act, the $53 billion CHIPS and Sciences Act, and the $2 trillion Inflation Reduction Act. In the words of one of the world's largest asset managers, Larry Fink, the CEO of BlackRock, the U.S. won't see a hard or soft landing in 2024. It may be that the combination of an accommodative Fed and the onset of the fiscal stimulus associated with the legislation that has passed Congress propels our economy forward in 2024. The prospect of monetary and fiscal stimulus may be equivalent to Goldilocks getting honey with her porridge. Whatever the case, Goldman Sachs raised its S&P 500 price target on December 18, 2024 to 5,100, which could imply an approximate 8% uptick from where we are now. Time will tell what happens. Until then, it may be useful to reiterate our prediction of a short, shallow recession.
On the back of a slowdown in consumer spending, our base case remains that the U.S. economy will experience a mild recession beginning in the second quarter of 2024.
However, this may not necessarily be a bad thing. Do you recall the last mild recession we experienced and what happened to the stock market? Please review what happened during the COVID-19 recession to the S&P 500 index from December 2019 through December 2021 from the J.P. Morgan article titled Eye on the Market. From this chart, we see the stock market represented by the S&P in blue appreciate even as the economy represented in green continued to slow down. The key insight is one we have shared before in the words of J.P. Morgan's Michael Sembalist: equity declines precede the fall in earnings, growth, and employment during recessions. So, what may we reasonably expect going forward? Let's begin with what has already transpired. Please see this chart. Mortgage rates have fallen. This may catalyze the struggling housing sector. Moreover, the prospect of falling interest rates may also stimulate a rotation into more interest rate and economically sensitive areas of the market as rates and economic pessimism have likely peaked, which could give way to further participation from YTD laggards. Our year-end target for the S&P 500 is 4,850, implying an appreciation of less than 1.5% from the Friday, December 15, 2023 close of 4,771.25. From this chart snipped from page 11 of Institutional Equity Strategy 2024 Outlook, a rotation into defensive and interest rate sensitive names seems likely either way. We see that outperformance was concentrated in large cap technology, communication services and consumer discretionary, the Magnificent Seven. This chart shows the extraordinary outperformance of this group. To put it another way, 493 companies were up low single digits, while the other Magnificent Seven were up about 70%. This may not be the time to chase large cap tech as it has already had a meaningful run higher this year. However, now may be a fantastic time to add small and mid-size company stocks to your portfolio. Please see this chart for more details. This asset class has not appreciated as much as the others. Further, this asset class, as stated, may do well when the Fed pivots. Consider this chart from the attached Goldman Sachs Q1 2024 Market Know-How. It highlights the relative factor performance throughout stages of economic cycle. This chart demonstrates that companies with strong balance sheets that return cash to shareholders may outperform when moving through a downturn like the one we expect next year. The final chart from our Institutional Equity Strategy Group argues for the outperformance on defensive and interest rate sensitive securities. Please see this chart. Real estate may be the last asset class that may be a good place going forward on price and performance attributes. Please contact me to discuss how we access small cap investments and listed real estate in our discretionary models. In the meantime, happy holidays. Love to you and your families.